Welcome to our latest PSE video. This video is being produced to answer the multitude of questions that we received a week or two ago when we held our latest Boom Bust Bulletin webinar. I'm delighted to say I'm joined by PSE Director Akhil Patel there in London. Akhil, good morning. You ready for these questions today?
Good morning, Darren, or good evening, I should probably say, where you are. Yeah, no, very much looking forward to it. Got a lot of questions, some very good ones, some common themes. Hopefully, we'll cover most of those, in the next few minutes.
Great to have you with us. And yes, you're quite right. So what we've had to do for the purposes of the video, we had so many questions that overlapped or were very similar. So we've basically put them into their own groups, and Akhil's going to provide answers which we hope manage to cover the vast majority of all those questions. So without further ado, we'll get started. We're going to start looking at the questions regarding to gold, silver, copper, and commodity prices, Akhil. And the first question for you is, do you think gold, silver, and copper will peak after the stock market crash, much like we saw in 2008?
Yeah, that's been our forecast for quite some time. You tend to find as the stock market peaks, there's a kind of an additional few months of capital rotating into the commodity markets, partly because of inflationary concerns, partly because there's momentum. In the case of gold and silver, there's a bit of fear and panic as well, and so they can be places where funds are parked for some time for some additional kind of investment gains. It doesn't last forever as economies move into very significant recessions. Commodity prices come down, as loans are called in and so on, things have to be sold, including gold and silver. So, they can crash hard, but you typically find a peaking process after the stock market. And we've got no reason to think that this time will be different. And in fact, there's seems to be quite a lot of strength in the commodity markets at the moment.
So speaking of the commodity markets, another question on the night was, what do we see commodities doing for the next 2 to 3 years, given we're right near the peak of the current real estate cycle?
Well, you'd expect overall there to be some pretty significant strength in commodities for various reasons. Some of it is because there is an enormous build out going on of data centers and other infrastructure in various parts of the world. Obviously, there's a lot of concern about energy supplies. That's had a knock on effect in terms of agricultural commodities. So across the board, there's quite a lot of strength in commodities. Expect that to continue for some time. During a crisis, commodities do come down quite hard. And then what happens after that, I think really depends. In the late 70s, for various different reasons, commodity prices were quite elevated. Had a very significant run in the late 70s in gold and silver, but also there were spikes in various agricultural commodities. Not so much the case in the early 90s. It was different part of the Kondratiev wave or the long cycle. In 2008, we had a very significant crash in commodities in 2008. And there was also, after that, very significant stimulus by China and the US, which pushed up demand for commodities again. So we had quite a nice run from 2009 to 2011. Now, whether we get that sort of recovery this time around, I don't know. It sort of depends on how the response to the crisis goes. And obviously, it's quite hard to predict that at this moment in time. But it's definitely something I'd be watching for.
I must admit, on the night, I was fascinated by this next question. I haven't seen it before. So let me quote it directly for you. The average price of a UK property in gold terms, 225 ounces per house in
Right.
1973, and
Yeah.
it's now about 250 ounces per house today. So in 50 years in real terms, not nominal, not much increase in price. Now, what did you think about that question?
It's interesting. I mean, there's actually quite a lot in it. So just for clarity, it's not the case that prices in 73 and now are the same in real terms. Real means inflation adjusted, not in terms of a commodity. And gold isn't money, though I know a lot of people say it is. It's not. So I think that's the first thing. The second thing is obviously in 1973, gold prices were really quite low, and if you'd counted it from say 1980 when they're elevated, you wouldn't get the same result. So the timing does matter, and I've seen a lot of people who are quite supportive of gold backing the money system, actually playing around with the start and end dates to get. a nice result to show how gold has gone up and other things haven't. I think just be careful about those that kind of analysis. But the point is that there has been a big run in gold. If you look at UK house prices in relation to gold in the last few years, I mean, gold has gone up much more significantly. So I suppose the question is, do you want to sell your gold and buy a house? Well, given what I've just said about, gold after a period of consolidation may well continue to rise into the peak and beyond of the cycle. Maybe it's not necessarily the best time to do that. UK house prices aren't going up at the moment, and in some areas they're actually coming down. So I think you can afford to be a bit patient on that.
Another really fascinating question, though. I'm glad it was there.
Yeah.
So the next section here, and this is one that obviously is clearly near and dear to many people's minds, is about the panic, the upcoming downturn, next into recession. What do they do? We had a question here that we'll start with that mentioned what's the estimated danger zone, quote, that marks the beginning of the financial collapse with a Lehman Brothers like event. Now, this is referring back to the 2008, 2009 crash. Do you have any thoughts on what might be our next Lehman moment in this cycle?
Well, it's complicated. I don't is the short answer. I mean, I can have a guess to give a slightly longer one. We are seeing various assets start to show some signs of problems. Now, the thing that everyone is currently talking about is private credit. Jamie Dimon, the CEO of JP Morgan earlier this year, referred to cockroaches. And if you see one cockroach, i.e., collapse of a private credit institution, there are other cockroaches lurking around. In other words, there are sort of problems in the financial system. My kind of slight issue with that is if everyone's talking about it, markets tend to price in some of this kind of information. So I'm not sure it's quite as clear cut. I'd be a little concerned about organizations that are borrowing quite heavily to, acquire, high-end chips for, building data centers and other things. Some of the financing around that is quite murky. And also, it's the kind of the business case for building out at this scale, at this speed, at this price. I'm not sure is particularly certain. I think there's a lot of hype, so that's a possibility. You are seeing various sort of financial products that are kind of tethered to things like Bitcoin. I don't know how much the scale is, but I think the point really is that there are a lot of different sort of avenues where something might create a problem. And on the point about scale, it doesn't have to be a very significant scale. Subprime mortgages weren't huge in the last cycle relative to general mortgages and mortgages of much sounder quality. The problem is that it just requires something at the margins of the system to start having a cascading effect. Hard to predict in advance, something that we are very much looking out for, something that we encourage our PSE subscribers to write in and give us some of their thoughts about all of this, because the more eyes looking out for problems, the better. I think we are fairly close to finding out what the problems might be. I'm just not sure I've really seen it yet. I suppose is the only thing I can really say at this moment in time. I think the important thing is just to be following closely. We try and engage with our subscribers quite frequently to give our latest thoughts on this, and we'll continue to do so over the next 12, 18, 24 months.
Now, I think the issues with private credit recently as well, and you've got that famous case there, MLC in the UK, that could perhaps be a Bear Stearns moment that's resonating from the
Yeah,
last cycle.
exactly. I mean, I don't see the thing is though, not many people were talking about subprime mortgages really in until the start of 2007. And by that point, you'd already had large banks writing off various loans they'd made to various institutions. You've seen a little bit of that. I mean, HSBC is recognizing a $400 million loss based upon the mortgage arm of the UK lender. But that news has been out for a bit of time. The sort of confirmation of it was just when it publishes its results. And so, I think the markets have been relatively quick to price it in some of this. It's kind of what the markets are not really looking at that I think is the key thing. So, and it may actually be some externally generated shock. I mean, they are the cause of problems, but if something happened in the Middle East that caused another massive wave of inflation and very high interest rates, things would start to crack even if they look quite sound at the moment. So we just have to be vigilant, and we'll certainly be writing and talking to our subscribers as much as possible about this sort of thing.
I agree. Yeah. And as you say, something for us to watch carefully.
Yeah.
So a few questions here now. So these are like, actionable advices. So someone asked, is it time today to start moving over into government bonds?
Again, difficult to answer that. It depends on what you're trying to do. I do think in general government bonds are a haven of quality. I know there's a lot of concern about the US government collapsing and so on. I really don't believe that will happen. I think government bonds are sound. The problem is the kind of any changes in interest rates, yields, and therefore on the price. And if you're holding to term, it doesn't really matter. These fluctuations, you just collect your 5% coupon, and if you're happy with that and that works for your investment portfolio, then certainly do that. At the moment, markets are still on the whole going upwards. Well, the US is certainly, Japan is, Australia and the UK and some of the European indices are sort of more sideways, but there is some growth in various sectors of those indices as well. So if you're managing your risks, you can certainly still be a equity investor. But if you wanted to have some diversification out of that, and fixed income government bonds would be a possibility. The only problem is that if you get further yield increases, which we might well do given the geopolitical situation, inflation, and so on, it will lose capital value. And that might be a problem. It might not be. It just depends on your investment kind of horizon.
No, that's good. In fact, I know Ken Walsh is due to take over the US Fed chair position this week,
Yes.
and the market's already betting he's going to have to raise rates in December because the or
Well, you see
inflation.
that is it's going to be a very, I mean, financial journalists love this. Is the kind of the instructions from the president who's not going to
Yes.
give in. There's this guy in the middle who's trying to pretend he's sort of independent. You could see he was trying to sort of balance two kind of irreconcilable forces in his answers. There's the actual economic situation. Inflation is going up, but will the US somehow fudge the data? Are there any other kinds of things you can do to try and suppress bond yields, which actually they are doing. The U.S. Treasury is issuing a lot of short-term paper, which pushes down prices at the shorter end of the yield curve, starving the longer end of the yield curve of Treasury bonds, so that kind of caps the price at that end as well. Yeah, it's a bit of a push and pull, and it's not entirely clear how it's going to get resolved. But in the underlying soundness of the instrument, I think is fine in terms of being a haven for your capital.
Mm. Speaking of havens, question about where will our cash be safe when things get really bad? Are there risks that you're seeing of bank collapses or bail-ins? And also, someone asked about service-based businesses like your plumbers, electricians, your trades. What kind of effect may they have in the downturn at the end of a real estate cycle?
Okay. Well, let's deal with the sort of cash and so on. Look, I mean, some governments may have legislated for the possibility of bail-ins and that sort of thing. I really don't see that happening in the US, in the UK, and Australia. It might happen in a small economy like Cyprus, where they don't have their own currency, and it's not clear whether they will get a bailout from the central bank and so on because of political issues, as we saw in the early 2010s. Very different scenario for a monetary sovereign, with a quite large and relatively stable banking sector, or in other words, some large banks and so on, a deposit insurance system. So if you've got cash in bank accounts, you respect deposit insurance limits, it's a sound bank. I think that is a perfectly sensible place to have some of your capital. So I don't see it as a risk. I could be wrong. I could, something else might come out, and of course we'll write to our subscribers about that. But I really think some of these concerns are overblown. The question on service businesses, I mean, that's really interesting. So, well, look, in a downturn, people spend less. That's the reality. So it depends on what part of the service industry you're in. But if you're a plumber and people are have blocked drains, I mean, there's nothing you can do about it. You have to get them sorted out, and you have to call your plumber. So there will be demand, but the prices you might be able to command might be different. You might find that a lot of people turned to plumbing to make income if they're, been sacked from their construction job. So there might be more competition. The market might not be able to bear quite the same call out rates that plumbers are able to command now in the UK. In London, it's incredible how much you have to pay for plumber. I'm not saying it's not worth it and so on, but it's just a lot more than it used to be. So they are to a certain extent immune to the extreme level of recessionary forces, but that doesn't mean that sort of economic conditions can't change, which would have a sort of negative impact on revenue and earnings. So I think you should bear that in mind. But I mean, again, think back to what happened in between 2008 and 2012 and see how plumbers and other service businesses survived those periods. It will give you a guide to what would happen this time around.
There was such a term as AI-proof jobs. You'd think that these would fit that bucket, don't you?
Yeah, if the concern is around AI taking over jobs during a downturn because businesses want to cut costs and this would be a way of doing it, yes, of course, there is always that. And therefore, if you're an industry where you can't, outsource your job to a large language model and or a robot, and that's of course robotics is further behind, then yeah, I mean, you're in a decent position. And so, craft-based businesses or businesses where physical presence and manual labor is important will survive the kind of AI
Mm.
revolution.
So the last question in this sector, and this is about someone who is not just as a person, but their life work is very, very near and dear to the hearts of all of us here at Property Sharemarket Economics. It's about Fred Harrison. Let me quote the question in full to you because it's quite important. Fred Harrison predicts that the crash of 2026 to 2028 will be more significant than that of previous cycles, and that house prices may not recover for, quote, a long time. Can you provide any comment on that?
Yeah, no, I'm quite familiar with Fred's more recent writings, and I should say actually we're recording this on the 13th of May. He's just launched his latest book
Make sure you
called
buy
Cheating.
it.
Make sure you buy it on the Shepherd Walwyn website. And if anyone's interested in attending virtually or physically the book launch, it's taking place on Saturday this week. I don't know when this will get to you, but there might be a chance to purchase a ticket at the last minute. Yeah, so Fred sees the convergence of a lot of different crises at once, and because governments have run out of fiscal capacity to engineer recovery, it might be a long time before the system can be reset and prices can be growing again. I'm not sure I really share that view. I mean, I'm not saying that things aren't bad and won't get a lot worse because I think they will. Governments will probably find a way to bail out the system. It's also possible that the banking crisis is not as significant as it was in 2008. I think we always have this sort of thing that banking regulations are put in place to solve the last crisis, and then banks spend the next sort of 14 years of the current cycle to unwind all those regulations so that they can start lending again in a crazy way. I mean, there is an element of truth to that dynamic, but it's also the case that, regulations do have an effect and they have limited the ability of banks to take very significant risks, particularly in relation to kind of mortgage lending and so on, which is one of the reasons actually why there was a gap in the market for things like private credit to move into. So if you don't have a very, very significant banking crisis, maybe that's one element of recovery that can take place. The other element is I think we are on the cusp of a pretty significant economic revolution driven by AI, but not just AI, and that creates opportunities as well as problems. And when you get opportunities, you get growth, and when you get growth, you get kind of the land market moving again because new businesses need to form, they need to be located, people need to move, etc., etc. So there you start to get activity again. Now, whether that is going to be consistent across the globe is a different question. So maybe, in parts of the US, it will be very sort of quick recovery. Maybe in Europe, it will take longer because, in European countries have more adjusting to do to the new reality. I think these are all very interesting, pertinent questions, which I don't think you can really answer right now. So I agree with pretty much everything Fred says, but I don't agree with the sort of necessarily the level of doom and gloom that he has about the future cycle. But that's probably as much as I'm going to say right now. I will be spending a lot of time in the next few months and years thinking about this and letting people know what I find.
I think it's easy at face value start to panic internally when you hear and see a lot of the things that Fred, has published and put out there on video in the lead up to his book. But
Yeah. I mean, can I just say one thing just while we're on the subject of Fred? I mean, so those of you who are not familiar with his work, I mean, he rediscovered the 18-year cycle in the late 70s. He wrote about it in the 80s. He tried to warn people about it in the 90s, that the 2008 crisis was going to happen. He's probably one of the principal reasons why you and I are talking about 18-year cycles because of his influence on us and on Phil and other people.
absolutely,
He's also been a very passionate campaigner for reform. He's kind of advocated changing the fiscal system so governments don't tax your wages, they don't tax business profits. You're adding value to the economy, and so you should be allowed to keep that. But he's always advocated very consistently taxing unearned wealth. So, the idea that you can buy a property, it increases in value. The building deteriorates in value because, any homeowner knows things fall off the building and need painting and so on. He said that unearned wealth is what should fund society. Quite how we've got a system which does the wrong thing at almost every step been the kind of focus of his research and more recently. And this is where the kind of idea of cheating comes in. He said that the system has been so corrupted both on a political point of view and economic point of view, but also in terms of its culture, that we kind of justify cheating and we resist reforms that have been known about for well over 140 years. And that's what he's been pointing out in his more recent writings. And what he also thinks, and I think this is the most important argument, I really do encourage you to read his book. The most important argument is this idea of pooling the kind of common wealth. So society is supposed to get richer as we get better at doing things, as we divide our labor better, and so on. That some of that creation of wealth shows up in better wages, it shows up in more business profits, but it also shows up in terms of kind of higher land prices. Economic rent is what we call it, and that is the fund that's supposed to support our development. What Fred points out is that that is the reason why we were able to evolve as a species, going all the way back to our sort of primal ancestors that actually funded our development. We human society until the last 5,000 years always found a way of pooling this kind of resource for the benefit of humanity as a species. And it's the only reason that we have been able to create the world that we've created. Now the system has got corrupted, it's got perverted, and he said he's of the view that it gets to a point where civilizations start to collapse, and you can go through the historical records and see that. Now, are we on the brink of that? Well, he obviously thinks we are close to it. I'm not sure I necessarily see it quite that way, but I do know that without some serious reform, things are going to get quite difficult. And maybe that's where I do agree with him and where I am paying close attention to what's going on because, I think pretty much everyone can see that the system is highly corrupt. It doesn't deliver good kind of welfare for everyone or even for the majority of people. And unless you reform things properly, you will get all sorts of funny, dangerous, dark ideas taking over that have a much more seductive appeal. So anyway, that's slightly long aside, but I think it's quite important for people to understand both kind of Fred's work and kind of where he's coming from in terms of his kind of perspective on these things.
oh yeah, for sure. I mean, we've been asked this question multiple times all this year as the build up to Fred's book. And we say, don't panic, get educated. So I urge everyone, please, this could be Fred Harrison's last ever book that he writes. We just don't know. But get educated, read that book, inform yourself. It's critically important.
Yeah.
So, no, well said, Akhil. So, okay, so a little segue now. So we're about to touch on real estate here in Australia, the UK, and overseas. Now it's almost 7 p.m. here in Canberra on the 13th of May. The government has handed down its May budget announcement overnight. Now,
Yes.
Now, on the webinar, at the end, I said our government here has been digging its own grave for years, and when the budget is released, it's probably going to have to lie in that grave. I do not change that point of view after it. But please let me just say to folks, there have been changes, not legislated yet. They're not law, but there have been changes to negative gearing, to capital gains tax, business write-offs, all this sort of stuff. But a lot of it does impact your investments, much like, and I'm sure Akhil would know, the rules and regulations and taxes changing in the UK doing similar. So I advise everybody, please go speak to a financial advisor or your own advisor specifically about how they affect you because it's it's a wide-ranging issue at the moment, and it may have a a small amount of the things that we're going to talk about here and the advice and the guidance we give. You're going to have to take that advice and then go to your advisor and talk about the changes the government's made as well. I think that's the main point I want to make there. So, as I said, so real estate. So we had the usual questions about the right time to invest in property in your big Australian cities, Sydney and Melbourne. Questions about Brisbane because of the 2032 Olympics, and how do we think real estate in general in Brisbane will play out between now and the Olympics? So, what are your immediate thoughts on the future of Australian property, Akhil?
Ha. Yeah, it's a small question, that one. Look, so I think there has been some observation about how prices in Melbourne and Sydney haven't really done all that much, if I'm not mistaken, or at least not in general. Maybe there have been parts to the outer fringes where things have moved over the past few years. I think this is, to my mind, a repeat of the previous cycles, and actually, to some extent, you're seeing this in central London. I'm sure in Manhattan, other places like that. The really big cities in a country, or the centre of cities in those big cities, do really well out of the crisis. The first half of the cycle, second half of the cycle, they don't really do all that much because prices are already high. People are priced out. They need to look for property elsewhere. While in prime locations, you get some infill development. You don't get, there's not spare land to do massive housing developments. That happens further out. So I think you've had that kind of pattern repeating itself in Australia and the UK and elsewhere over the last sort of 14 years. So it's not surprising that things haven't done all that well over the last few years. It does mean, though, when you do get to the crisis point, the centre of those cities and best locations in a country recover first, because that's where the demand, where the jobs are being created, that's where people are moving to or moving around in order to get those jobs. And I don't expect that to be different this time. And then to a certain extent, if you are able to buy, if you are seeing prices come down in particular prime locations, you might want to take the opportunity to do that. And now I know we haven't got to the kind of end of the cycle, but the reality is that in best locations, what you want to purchase doesn't often become available. So it's kind of a judgment call on your part. Don't over leverage. Don't make sure that if you're renting out, there's plenty of margin of safety and so on. But property is ultimately a locational asset, and it's not that you can, if you want to buy a stock, you can phone up your broker or get online and buy it at any point. Property is very different. So I've kind of hopefully explained the sort of dynamic that is at play. In relation to Brisbane, now we've seen this pattern as well. So prices may come down in a downturn. They're not going to come down very much because there's a lot of infrastructure going in, a lot of new building and so on. It's the whole place has been given an uplift, and people are going to want to move there for work and for other reasons. And so you would see probably quite a swift recovery if indeed there is much of a downturn in the first place. And something similar happened after 2008 on the eastern part of London, where the London 2012 Olympics were. And we actually had quite a significant downturn in the UK. Maybe it was relatively swift. In some parts prices did come down quite hard, but in the areas where there was a lot of activity, so in central London, but also in eastern parts of London, they recovered very quickly and very strongly. And I would imagine the same dynamic would apply to Brisbane, and indeed before the 2032 Olympics, we have the 2028 Olympics in LA, and I think the same thing would apply there as well.
Yeah, absolutely. I mean, this is something that there is actually a long historical precedent for this type
Mm.
of thing. I recall Homer Hoyt in his 100 years of land values in Chicago. In 1890, the US had one of its worst ever recessions.
Yeah,
Prices fell everywhere in the country except one place, one city, and that was Chicago. Chicago
but
boomed because they were next to hold the World Trades Fair, which is back then in the 19th century was the equivalent of the Olympic Games. It was massive and it was something that went around the world. So it was
right.
even happening back then. It
Mm.
defied the very worst recession in the United
Yeah, yeah,
States.
yeah.
So there is a long precedent for us to, I don't think we're guessing here at all to
Mm.
say, look, there is a strong corollary between events like this and the effect they have. What happens for the rest of the cycle, when there's no more infrastructure to build is another thing. But no, I think you summed up Australia quite well, Akhil. Yes, you're right. Sydney and Melbourne, look, it's soft. Vacancy rates are starting to rise. Rents are still good, but prices have certainly come off. Your Perths, your Brisbanes, your Darwins, the commodity facing states
Mm.
in Australia. Of course, there's some of the strongest for those reasons. And yeah, I expect select suburbs in Brisbane at or around where the infrastructure has to go in will be very well performed, even if Australia does have quite a significant a slowdown in its overall real estate.
Mm. Okay,
Um,
no, very good.
yeah, no, great stuff. So it seems we had some attendees on the night from the European Union and India, and that's fantastic. Welcome to you. And they've asked some questions about what are your expected outcomes for the European Union and, in particular, Scandinavian countries out of this current cycle? And also a question about where is India within the overall 18.6 year real estate cycle?
Yeah, these are good questions. So, I mean, most countries that are, part of the sort of advanced world, quote unquote, tend to follow the US in terms of their progress through the cycle. And I think that, if I'm not mistaken, Scandinavian countries, particularly oriented towards exports, have been doing rather well in recent years. And if I'm not mistaken, property market has reflected that. Now, there are often sort of different sorts of regulations in place, so it might limit the amount of speculation that takes place. So they might not have as massive a boom and a bust as other parts of the world. The in famously in Europe in the 2000s, it was on the European southern periphery that the kind of, and the Western one, so Ireland, Portugal, Spain, Italy, Greece had the most significant boom and bust from 2000 to 2008, 10, and so on. The dynamic applies all over Europe, but the actual experience of it is different depending on various local factors. So, if we have a major crisis, as we're expecting in the next couple of years, you would expect that to have a quite significant bearing on the prospects of the economies in Northern Europe, for sure, particularly if you're exporting a lot to the rest of the world and demand is drying up. It won't be avoided. It might not be a significant crisis from an internal point of view in terms of, maybe the banks are still fine and maybe businesses can access finance, and so on, but they won't be immune to any kind of problems that we have. That's the EU. India. Now, that's a really interesting question. We don't really have enough data going back far enough to really sort of outline the presence of the 18-year cycle in India, first of all, and the sort of same timing as the 18-year cycle. And that's partly because, India was quite a poor country for a very long time. It's obviously one of the world's largest economies now. It was very socialist kind of orientation until the early 90s. Very difficult to kind of for businesses to set up, and there's a lot of bureaucracy, a lot of corruption, and so on. But from the 90s, it has developed very, very rapidly. And that has been accompanied by quite a lot of property speculation. I think that, I mean, there was somewhat of a downturn, if I'm not mistaken, after 2008, but I don't think it was very significant. And this is what you find with countries that are developing rapidly. They almost don't see the worst effects of the downturn because there's so much latent potential that they kind of keep going. You saw this with Japan in the 50s and 60s and 70s as well. Kind of ruined country, developed very rapidly. I mean, it was assisted a lot by the US and by Western Europe. Developed very rapidly, didn't have much of a downturn in the 1970s, unlike the US and the UK and so on, banking crisis and other things. So maybe you're having a similar story with India in the kind of 2008 period. We had a new government in 2014 that was really keen on clearing things up and, you know, putting the economy on a kind of more advanced economy footing. I think to a large extent has succeeded. And then you've seen the results of that, which is a massive boom in property prices in a lot of places. And I was watching a video on, skyscrapers in Mumbai and turning some of these shanty towns into kind of high-end developments because of the location and so on. I mean, there's this enormous amount of activity. When the downturn hits globally, to what extent will that affect India? Well, you would think because of the extent of the boom, there would be a very significant downturn. But again, going back to my point about how much further potential there is in the country, it's hard to say right now. I would say to anyone who is an investor in India and or has got some property interests to understand the cycle and to make sure that you are not taking too many risks. But I wouldn't say necessarily that means you've got to sell everything and go into cash and all that kind of stuff. I'm not saying that at all because there are always opportunities even in downturns that you might want to take advantage of. I just want to make sure that you're not overexposing yourself in the sense that you would be forced to sell some of your investments at a time when you don't really want to, because it might be a possibility. It might not. Again, as I said, it might blow through all this. It's possible it has a different cycle timing. We don't know. This data's not there, but I would, if in doubt, I would sort of just kind of follow the rules of how you would play a cycle. I've outlined a lot of that in my book, and we talk about it to our subscribers a lot. It's just be sensible.
India's fascinating. I mean, I wrote about it in a BBB edition a few
You
years
did, yeah.
ago. Yeah, and so India gained its independence in what was it, 1949? Is that right? Or
47.
1947, sorry. But
Yeah,
it
yeah.
didn't industrialize straight away, did it? It took a long time before it, perhaps as you said, the late 80s, early 90s, it started to become sort of that
Well,
more
I
industrialized.
mean, it's sort of industrialized, in the 50s and 60s, but it was a very much centralized socialist kind of economy, and it wasn't,
Yes.
didn't have the same dynamism. Well, to be honest, I'm not sure I can really say that. I don't know enough of the history, but the sort of stereotype is it didn't have the dynamism it does now. Maybe that's fair, maybe it's not. But it doesn't appear to have had the same kind of boom and bust sort of out excess speculation and kind of banking collapse that we saw in the West. Um, but we have seen this before as in countries that are rapidly developing that they sort of you don't think they might have a cycle, so they just keep going up and up. There's so much potential, like Japan in the 70s. But of course, very famously in the late 80s, it had one of the most enormous crises in modern history, such that it took them 20 years to sort things out. So it's a cautionary tale. Whether India's at that point in its trajectory, probably not. But that doesn't mean to say that it can't experience a significant downturn if it's had a very significant boom before it.
There's certainly lots of behavior that we assimilate with the real estate
Yeah,
cycle in more
certainly.
developed countries, though. That's always a
Yeah, yeah,
telltale sign, isn't it?
exactly.
That they are fed. So, last question for tonight. And again, small question, but I'm sure this will be a big answer. People are wanting to know, do you see artificial intelligence dictating the next recovery? So this would be once the US peaks in its land and stock markets, has this downturn for 3 or 4 years. Do you think artificial intelligence will be the driver that will get economies out of that low point and start us into the next real estate cycle?
Yeah, I do.
Mm.
So the general kind of insight from history is that the each new cycle is kicked off by say new technology, by the application of a new technology in ways that we haven't really seen before. That creates a lot of new possibilities, new jobs, new businesses are started, and sort of gets things moving again. Obviously, there's a lot of adjustment in other segments of the economy which take longer in some cases. I do think that the application of AI to businesses, and in particular agentic AI, will be the thing that creates or opens up all these new opportunities. Not the only game in town, but I do think it's probably the primary driver of it. So yeah. Now, what that means in terms of job creation and so on, of course, that's a very hotly debated topic at the moment. I'm not going to pretend to know the answer to that. But in terms of the kind of underlying dynamics of the cycle, I do think that will lead the next one forward.
Yeah, I mean AI is almost viral. I mean, we've had the massive rally in the US stock markets um, since the seasonal low in late March. But I've also noticed though a lot of emerging market indexes, and Akhil, you'd be familiar that we've always stated that in the second half of the cycle, emerging markets do tend to outperform the more traditional markets on
Yeah.
a cost basis than US and stuff. But
Mm.
even they, if you look at the constituent parts of these funds,
Mhm.
the outperformers, Samsung,
Yeah, yeah,
Taiwanese semiconductors, all technology or exposed to the AI, even in
yeah,
emerging markets. That's what's driving the growth lately in them as well. So it's just like it's just taking over.
yeah, absolutely. It's, I mean, it's the game in town in terms of
Mm.
investments. If you stripped out the performance of these large AI stocks and associated ancillary service companies and so on, the stock index would look quite different. The emerging market story is, of course, also about commodities. A lot of emerging market countries are commodity producers. Um, but I think what we've seen is that the AI part of the story is so dominated that it's kind of all the other stuff has kind of got a bit lost. And so it's sort of maybe, at least on the face of it, changed some of the trends that we might have expected to see a bit more easily. But it's still, the underlying dynamic is still there. So it's been really interesting to kind of follow this through. And PSE subscribers, I think, will have, at least if they've been with us since the late 2019, so now coming on 7 years. I hope they will sort of agree that a lot of the call that we've been making over the last few years have started to kind of show themselves to be relatively prescient. Of course, you're only as good as your last forecast and so on, but I think it's been pretty good.
That's a perfect way to end this. Goodness me, we've covered an awful lot in a short amount of time, Akhil. But on behalf of everyone who will be watching this and myself, thank you very much for your time. I know you're a busy man and it's early in the morning there in London. We do appreciate you bringing your experience, your expertise and wisdom to our Q&A session tonight. So thank you.
Well, thanks, Darren. Really enjoyed it.
Yeah, it was great. And we will look to get this out very soon, the next day or two, to all of our paid membership tiers. And once again, a big thank you to all those who attended the webinar, provided the questions. I do hope and trust that we've covered the majority of them for you. So, on behalf of myself here in lovely cold Canberra, I wish you all a good night.